Hello everyone, my name is Cynthia and today I will be reviewing Unit 1.3b, Time Value Money Concepts and Questions. Starting off with what is discounting. Discounting is the process of determining the present value of payments to be received in the future. Discounting is a primary factor used in pricing a stream of tomorrow's cash flows. Now we are going to go into the difference between ordinary annuity and annuity due. Starting off with annuity due. Annuity due is an annuity whose payment is due immediately at the beginning of each period. A common example is rent, as landlords often require payment upon the start of the month as opposed to collecting it after the renter has enjoyed the benefit of the apartment for the entire month. In contrast, the payments in ordinary annuity occurs at the end of the month. And this can be an example of a bond payment. Now, what is a non-annual cash flow? A non-annual cash flow are cash flows which are not given as dividends per year. Instead, they are given at less constant intervals. So anything that is more frequent than once a year. Uneven cash flows. Uneven cash flows are cash flows that do not pay out at a specific periods, either monthly or quarterly. So for example, if one month there is one cash flow and the following month there are 5 cash flows, it is not consistent through every single month of the year. Annual percentage rate, also known as APR, is the interest rate you pay on a loan, such as a credit card or auto loan, on a yearly basis. In simple terms, it's the cost of borrowing money. The effective annual rate, also known as EAR, can be used to evaluate interest payable on a loan or any debt, or to assess earnings from an investment such as a savings account. Now, what are some common questions regarding the time value of money? Starting with the first question, when should I start to worry about the time value of money? You should start to worry about the time value of money when you have an investment or when you have any debt. So this is critical to determine how much money you will owe or how much money you will receive. Are there expectations to the time value of money? So the time value of money does not have alternate ways to be calculated. So there is only one formula, and an important concept to keep in mind when using time value money is that a dollar held today is worth more than a dollar held tomorrow. Now, how do interest rates affect time value of money? So there's a big difference between a fixed rate and a rate that is not fixed and fluctuates. So for example, when you are investing, using a fixed rate can serve as an advantage or a disadvantage. It is an advantage because you know exactly how much money you'll be receiving, versus it might be a disadvantage because there's not a chance that it may go up. But that also has an inverse effect where if there's inflation, or a recession, your interest rate might not benefit you as much. So interest rates most definitely do affect time value of money. Now, how does the time value of money affect my savings? So time value money shows you how much savings can be worth if invested or put into a certificate of deposit or even a savings account. So the time value money and compound interest help make your cash worth more over time, and that's why long-term investing is always encouraged. Now, how does time value money affect my debts? So if interest charged on debt is high, it is extremely important and recommended that you pay off your debt as soon as possible. Otherwise, you will be paying more money towards that interest rather than just your debt. But for example, if you have a student loan and you have a low interest rate, then of course you have the opportunity to take your time and pay that off a little bit slower. Now, this is the last question, how does time value of money affect my investments? So the time value of money can show you which investments offer more return by calculating the present value or cash flow. So for example, if you have a certificate of deposit, also known as a CD, it affects investments and as banks offer a higher interest rate on longer terms than short terms. So like I mentioned earlier, long-term investing is always um, encouraged over short-term investing. So this concludes Unit 1.3. Thank you for listening and let us know if you have any questions.